Welcome to our 2020 webinar series. This year's webinar series will focus on the whys of insurance. LLIS offers many insurance solutions for fee-only advisors and their clients. We understand that with many options come many questions, which is why in 2020 we're tackling the whys of insurance. Each webinar will last about 50 minutes, and you must be logged on for the full 50 minutes to receive CFP credit. Please be sure to ask questions as you have them by typing them into the questions box. We'll answer all questions at the end of the presentation. Today's webinar is being recorded and will be posted on our website within a week in case you missed it. Today's presenter started working at LLIS in 1998. Since then, she's become LLIS's go-to person for connecting her clients with long-term care insurance solutions that meet their needs. Here's Jill McNeil.
Thank you, Claudia. Welcome, everybody. Thanks for joining us this afternoon. November is Long-Term Care Awareness Month, so it's only appropriate that we talk about long-term care and growing old. I've learned life is like a roll of toilet paper. The closer it gets to the end, the faster it goes. Regular naps prevent old age, especially if you take them while driving. Well, we can joke about growing older, but it's no laughing matter at times. This year, there's 56 million Americans age 65 and older. By the year 2050, that number is projected to increase to 84 million. Our population is aging, and the systems that we have in place, Medicare, Medicaid, they're taxed now. So how are they going to handle this increase of older age citizens? So it's important to talk to your clients about planning for the future and what are their plans? How do they plan to take care of their long-term care needs? Because if they have a long-term care event during retirement, it can certainly affect how they spend the rest of the years. And how much will that affect them? Well, let's look at cost of care around the country. Now, these costs of care came from the Genworth Cost of Care Study for 2019. These are median costs around the country, about 102,000 for a private room in a nursing home, just over 90,000 for a semi-private room, 48,612 for assisted living. Home health aid, 52,624, and homemaker services, 51,480. You may be wondering what is the difference between a home health aid and homemaker services. Home health aid is somebody that can come into the home and provide hands-on care, such as assistance with dressing or bathing or maybe medications. Whereas a homemaker services is somebody that comes into the home and provides hands-off care, such as light housework, food prep, grocery shopping. Now look at the increases in the last year. So for home health aid, costs have gone up 4.55%. Homemaker services 7.14%. Look at that. That's incredible. The three on the top, the facility care, it's been under 2%, so not as big. So what is causing this increase in the home health aid or homemaker services? Well, there's several things. Tight labor market, not so much now. This not these numbers came before COVID, and the information I have is before COVID. At that time, it was because of the tight labor market. People could be a little bit picky where they wanted to get a job. These licensed or certified caregivers could maybe get a job in a hospital or a facility and be paid more. And another reason for the increased cost is increased cost for complying with new mandates for state, local, and federal certificates. So costing people more to get licensed or certified to become a home health aid nurse. So maybe they'd go into another field. Also, changes in Medicare have prompting hospitals to discharge patients sooner with more care needs. So people are going home sooner, and when they get home, they need care. So there's more demand for these home health care workers. This chart I found just gives you an idea how much nursing home costs have increased. In the last 15 years, nursing home costs have gone up 57%. That's a huge increase. Not many things that we buy today have gone up 15%. I'm sorry, 57% in 15 years. So those numbers I showed you 2 slides ago were the median cost of care around the country. Care really varies depending on where your clients live, and they need to take that into account when they're planning for the future. What is it going to cost them to receive care if they stay where they are? So this chart just gives us an idea of the highest and low and least expensive areas to receive care. Least expensive, Louisiana, 45,000, then Texas, Missouri. So these numbers for the numbers they have average annual cost. So the average of licensed home care, adult daycare, assisted living, and nursing home costs. So they've averaged those prices to get these numbers. And then the most expensive states, Alaska, really not a surprise there, but look at that, almost double. Um, the other state, Massachusetts, probably not many of you have clients in Alaska, but I think a lot of you are in New England area, Massachusetts, Connecticut, DC. So again, Hawaii, it's an island, so cost of care, I'm sure everything over there is more expensive than on the mainland. So again, I just wanted to show you how care varies around the country. If you need any help finding cost of care, that Janworth cost of care map that I referenced two slides ago is a great source, or give us a call and we'll happy to help you find cost of care in your area. 77 million Americans identify as an unpaid family caregiver, and 71% of these people are caregivers are between the ages of 40 and 59. One third of parents with a child between the ages of 8 and 14 also care for an aging family member, and 68% of these have an older family member living with them. So not only are they providing care, financial support, emotional support for their children, but also an aging adult. So that's a lot to have on your plate, especially if you're working a full-time job and then you have to come home and take care of your children and also a family member. It's pretty tough. And how does that affect the caregivers? Well, they're also paying for cost out of pocket. 78% of caregivers say they pay for out of pocket cost to take care of their loved ones, and an average about 7,000 per year. If the caregiver lives at least an hour away from the one they're helping take care of, they're spending about 12,000 a year. They're spending more on gas and just other utilities and things like that to take care of their family member. And 25% of caregivers say they've reduced their retirement savings. So reduction in retirement savings for those that pay for out-of-pocket expenses is a compound effect of lost money saved. So they're living they'll have lost less interest earned also on their savings. And 23% of them say they take on more debt. If they're getting close to retirement age, taking on more debt is not a good thing. And since they're paying out of pocket for providing care, they have to end up skimping on their own needs. So their own household maintenance, groceries, not as much to put aside for education for their children, and then less to spend on their own personal items. And they also pay less attention to their own health. Less sleep. There's only so many hours in the day. They don't have enough time to get everything done and get a good night's sleep. Don't take the time to schedule their own routine health and dental appointments. Maybe they're taking mom or dad to their dental appointment or health appointments, and so they skip on their own. They're filling prescriptions for mom or dad. Maybe don't have time to take care of themselves, and they have less time to exercise, less time to get out and get rid of the stress. A lot of caregivers realize that their own health fails as they're providing care. So that sandwich generation that we talked about two slides ago, where you're taking care of your own children and an older family member, I don't think I said it, but that's considered the sandwich generation. So these people in the sandwich generation have firsthand knowledge of why it's important to plan for a long-term care event. I know, and you probably realize that clients that come to speak to you about long-term care, about the future and what it may hold, a lot of times they're the ones that have had experienced it firsthand. Either they've seen their own parents take care of their grandparents, or they've seen friends or family members or neighbors take care of older client, older family members, and they realize that your clients realize they don't want to be a burden to their own children, so they want to plan for this. And better to plan early. 47.9% of long-term care purchased is purchased between the ages of 55 and 64. So, and why it's important to buy it early. After age 54, premiums are 2 to 4% higher each year the client waits to purchase the policy. And after age 61, premium as much as 8% higher. So the longer your clients wait to purchase a policy, the more they're going to pay. They also have to keep in mind that if their health changes. As longer they wait to purchase, the older they get, the worse their health could be. I mean, I'm not saying everybody's health is going to decline, but the older we get, unfortunately, our health hardly ever gets better. Many times it gets worse, and not extremely worse, but a lot of times people are put on blood pressure medications, cholesterol, have heart issues, cancer. So if your health does change and you've waited to purchase insurance, you may not qualify. So always better to purchase while you're young and healthy. And how to pay for this care. So now you've talked to your clients about planning for the future, and they want to look at the different options. So, what are their different options to pay for care? Well, option number one is to self insure, to use personal income and savings to cover their care. So, if your clients are considering self insuring, here are some questions to ask them to help them determine if this is the best option for them. Will they be depleting their retirement income, therefore affecting their lifestyle? So if they have a long-term care event and they have to use some lump sums out of their retirement, that's less money there to receive interest and to live off of. Will they be relying on family members to provide their care? Do they have family members that live nearby that are willing and able to provide their care? Or do they want to ask them to do that? Will they need to liquidate portfolio assets, possibly selling at a poor time or creating unplanned taxes? Maybe they have to sell off that family vacation home that everybody enjoys using, and maybe they have to sell it at a bad time. So, not good planning. Do they have a surviving spouse who will need a certain level of assets? So, again, if one spouse needs care and they spend a lot of assets on that spouse, what's left for the second spouse to live off of? Or if that second spouse needs care, what's going to be there for them? So, option one, some clients can pay for their own care or plan on self insuring, but some can't. At LLIS, we have a rule of thumb that we use. If your clients have 500,000 of liquid assets or less, 500,000 or less liquid assets, they're probably not going to be a good candidate for a long-term care policy or a hybrid policy because the premiums are going to be a little too expensive for them, especially in retirement years. But if they have between 500,000 and 3 million, then they're probably good candidates to purchase some type of policy, either a traditional long-term care policy or a hybrid. The clients with the higher end of assets, 2 million to 3 million, may be good candidates for those hybrid policies because they can afford the upfront premiums. And you're probably thinking, well, if my clients have 2, 3 million, they can self-insure. They can self-insure maybe, but maybe they don't want to. Maybe they don't. They want to save their assets and purchase a policy that they'll have in place to cover their care. So option two for paying for care is to transfer the risk by purchasing a policy, either a traditional long-term care policy or a linked benefit policy, a hybrid life with a long-term care or a hybrid annuity with a long-term care rider. If your clients want to explore this avenue, here's some questions to ask them to see which product may be best for them. Is the long-term care the primary driver for the coverage? Or do they have other needs? Do they need death benefit for estate planning? Do they need some supplemental retirement income? They need an annuity? Um, Figure out what it is. If they just want the straight long-term care, that makes it a little easier. And how do they want to pay for this coverage? Do they want level lifetime premiums that they'll pay for the rest of their life, but premiums would be waived when they're on claim? Or maybe they can afford a short pay, meaning a 5 year or 10-year premium. After that period of time, they have a paid up policy. Or that big lump sum, they have some cash sitting available that they could use to roll into a lump sum. Or do they have existing life insurance or annuities that they could exchange to help jumpstart a policy? And do they want guaranteed premiums? Do they want a premium that's going to be locked in and not go up in the future? Are they reluctant to pay premiums if they never need care? Do they want to be guaranteed that they're going to get something for their money? So, depending on the answers to these questions, will help determine what type of product they want. So, let's get into that a little bit more. So, we're going to start with a case study here, and we're going to make Bill and Betty our case study, and we're going to say they live in Charleston and they're both age 56. They know they need some long term care, they need to plan for the future, and they want to know their options. They have no existing life insurance with any cash value. They could manage some short pay premiums, like a 5 or 10 pay premium, or they could do lifetime level premium. So we start by looking at cost of care in Charleston. 79,606 for a private room, 7361 semi-private room, and then you see assisted living 3590 and home health aid 4481. So this is what we normally do when we look at designing a product or a policy for clients. Look at cost of care where they live or where they plan on going in retirement. So for Bill and Betty, if they were looking for a fairly substantial policy, we would recommend they cover 80% of the most expensive cost. So the most expensive cost is the private room in the nursing home. This is 7966 for them. And why do we recommend they cover 80%? Well, when your clients are planning for retirement, they know that they have to have in their budget enough to cover the cost of living expenses, utilities, food, and other essentials. If they move into a nursing home, the cost for the nursing home is going to increase their living expenses by about 80%. So we would want to make sure that they have that extra to cover the private room in the nursing home if they want a substantial policy. So based on 80%, in this case, we'd recommend they look at a policy having a monthly benefit of $6,370. But Bill and Betty consider that, and they think, well, we have assets, so we could cover partial risk. We don't need to put 80% of the risk on the insurance company. We could handle some additional risk. They know they want to stay in their home as long as possible, so they want to make sure that they have home health care costs covered for sure. So it's decided that they want to cover 50% of the risk. So they want to cover 50% of the risk. They want to have a policy that would cover the other 50% of the risk. So they'd look at a monthly benefit of $4,000. Again, this covers 50% of nursing home costs. With the $4,000 monthly benefit, they'd have enough in the policy to cover 100% of assisted living costs and about 90% of home health care needs. So it's decided they want a $4,000 monthly benefit. What type of policy should they look at? They can look at a traditional long-term care policy, or they can look at a hybrid life policy with a long-term care rider. So let's start with a traditional long-term care policy. With this type of policy, it's just straight long-term care. You have a choice of benefit periods from 2 to 6 years, benefit amounts, usually the lowest around $50 up to $400 or um, $1,500 up to about $10,000 monthly benefit. Elimination period, most of the policies have 90-day, 180, 365-day elimination period. Some of the companies still offer a 60-day or a 30-day, but most of the time clients go with a 90-day. And inflation riders, we can still get 3, 5% compound inflation. None of the companies we work with still offer simple inflation. And then one company, Mutual of Omaha, still offers 4% compound inflation. So few variety of inflation riders available. But on these long-term care policies, the only option for premium nowadays is lifetime level premium. So cannot do a lump sum or a short pay or anything like that. Cannot do a 1035 exchange. The rules allow for 1035 exchange, but it's hard to find a company that will allow it. Again, lifetime premiums, and the premiums on the long-term care policies are not guaranteed. They can be increased, but only if the insurance company goes to the state and asks the state for a rate increase. They have to show justification for that. They have to show that claims are higher than anticipated, lapse rates are lower. If the state approves the rate increase, then every citizen in that state that has that policy series would have a rate increase. So rates cannot be increased on an individual basis. And near the end of the presentation, we'll get into a little more about that, about rate increases. So for Bill and Betty, for that long-term care policy, 4,000 monthly benefit, Recommend a 90-day elimination period. This is the sweet spot on these policies. Um, you can get a longer elimination period, but a lot of times the longer elimination period does not save enough on premium to justify the larger out-of-pocket expenses if they went on claim. Recommend 3-year benefit period and shared care rider. So with shared care rider allows them to share their coverage. Um, with most companies, they can share the whole 6 years. Mutual of Omaha requires that they save 1 year to each use themselves. So it depends on the company exactly how the shared care rider works. The reason we say 3 years of coverage, average length of stay for a male that enters in the nursing home is 2.2 years, for a female 3.7. So having 6 years between them covers the most likelihood event. If clients have some family history of Alzheimer's or dementia, they may want some longer coverage. And then we'd recommend 3% compound inflation. By having this on the policy, benefit will grow by 3% every year on every policy anniversary. Uh, this is a nice middle of the road. Mentioned that some companies still offer 4 and 5% compound inflation, but the 4 and 5%, the premium is quite a bit more expensive. So the 3% keeps the policy growing. Cost of care has been increasing about 2 to 5% across the country the last several years. Depends on where, what state, and also what type of care. So 3%, I get, as I said, is a good median. Here are the three companies we are working with for long-term care: Mass Mutual, Mutual of Omaha, and Transamerica. So for Bill and Betty, we could get that policy we wanted worth the $4,000 monthly benefit. Benefit period, 3 years with all of them. Uh, with Mutual of Omaha and Transamerica, we can get that shared care rider. Mass Mutual stopped offering the shared care rider in the majority of states several years ago, so we cannot get the shared care rider. And actually, last week we found out Mass Mutual is going to take their long-term care product off the market the end of January. They still have hybrid policies, but their traditional long-term care is going off the market by the end of January. Inflation rider, we can get the 3% with all three companies. With Mutual of Omaha and Mass Mutual, when you have the 3% compound inflation rider on, the premium stays level. The benefit increases by 3%, but the premium stays level. With Transamerica, through 3%, it's called stepped rated. So what that means is the benefit goes up 3% every year, but so does the premium. So the premium increases by 3%. Return of premium. None of traditional long-term care does not offer a return of premium feature. No death benefit. Again, it's just straight long-term care. The long-term care payment on these traditional long-term care policies, all reimbursement. So this means that the insured goes on claim, satisfies the elimination period, and then for their care, they have to pay out of pocket for their care. And then at the end of the month, they submit invoices to the insurance company. The company would reimburse them up to their daily or monthly benefit. The care that's provided has to be provided by certified or licensed caregivers. Here's the premiums for the three different companies. Um, you can see that Mass Mutual is middle of the road. It's right in the middle of the two, but does not have the shared care rider that we wanted, so we would not consider that. Transamerica is substantially less than Mutual of Omaha, but keep in mind that that Transamerica premium is going to go up by 3% every year. After 15 years, that Transamerica premium would have be the same level as the Mutual of Omaha premium, and the Transamerica is going to keep going up. In 15 years, Bill and Betty will only be 71. Good chance that they're going to be paying their premium for quite a few more years. So we would recommend that they go with the Mutual of Omaha policy and have the more level premium. Okay. So now let's look at a hybrid life policy. What is a hybrid life policy? Hybrid life policy is a permanent life insurance policy with a long-term care rider. It provides guaranteed benefits, either in the form of long-term care benefits or a death benefit. So as the client goes on claim with a hybrid policy and receives long-term care benefits, the death benefit is reduced dollar for dollar. Hybrid policies have guaranteed premiums. They cannot be increased by the insurance company. So, unlike the long-term care premiums, the hybrid premiums cannot, the insurance company cannot go to the state and ask for a rate increase. The hybrids have a return of premium feature. They have flexible premium options, single pay, short pay, 5 or 10 years, or lifetime premiums. Depends on the product, depends on the company. Not all companies offer all these options, but there's um, quite a few companies out there that offer hybrids, so um, have a choice of how to pay the premiums. And with a hybrid life, we can do a 1035 exchange. So if your clients have some existing cash value and some life insurance policies, we can do a 1035 exchange to jumpstart a hybrid policy. For this presentation, I'm going to focus on the linked benefit policies, where priority is long-term care. As I said, there's several hybrid policies on the market. Some of them are very basic hybrids, where the emphasis is on the death benefit. On those basic policies, the death benefit and the long-term care pool are equal. So once the death benefit's gone, the long-term care pool is gone. With those, you cannot not change them much. You cannot customize them. You cannot add an inflation rider. So for today, we're going to focus on the linked benefits policies with emphasis on the long-term care pool. We can add inflation riders. We have choice of benefit periods because those are the ones that really compare most closely to traditional long-term care. So think of the hybrid policies as three little piggy banks. Well, the first piggy bank, the biggest piggy, that's your long-term care pool. So if they need care, if the insured needs care, they have a tax-efficient, dedicated funding source designed to meet their needs. So he's the biggest piggy. The middle piggy is the death benefit. If they don't need care, they're able to give a family a legacy through a death benefit. And the little piggy, this is the return of premium. If they change their mind and want to get their money back, they can because they have return of premium features. So think of this with the hybrid policies, three little piggies. Nobody, no big bad wolf can come in and blow their house down. They're going to take care of themselves if they have a hybrid policy and need some care. So these hybrid policies, these linked benefit policies, the majority of them are individual policies. So for our example here, we're going to talk about a policy just for Bill alone at this point. And these are the three companies that offer decent policies, good policies, probably the most competitive policies right now for hybrid. Minnesota Life, which is Secure Care, Lincoln, MoneyGuard, and Nationwide. Um, so again, all three policies are good policies. We can get the $4,000 monthly benefit with these. Benefit periods are 4 years. Recommend 4 years due to the way the basic policy works and the rider. 4 years looks a little more attractive than a 3 year benefit period. So, and again, these are individual policies, no shared care, so there's nothing they cannot share the coverage. The death benefit, Minnesota Life nationwide, 96,000, Lincoln 104. So again, death benefits is not the focus. The long-term care benefit is the focus. So the long-term care pool on these policies is almost double the death benefit. Inflation rider, we can get that 3% we wanted. Return of premium, Minnesota Life, after 10 years of paying premiums, um, the policy has a 100% return of premium. And I apologize, I didn't mention, I ran these hybrid quotes to have a 10-year premium. So after paying premiums for 10 years with Minnesota Life, you'd have a full return on premium. Lincoln 70%. Nationwide, the return of premium, it varies by the client's age, sex, and the year. So really have to look at the individual illustrations to show what that return of premium is. Form of long-term care payment. Lincoln is that reimbursement, so the same as the traditional long-term care, the Mutual of Omaha, the Transamerica, Mass Mutual. But Minnesota Life and Nationwide are indemnity or cash benefits. So this means when the client goes on claim, the beginning of every month, the insurance company sends them a check equal to their monthly benefit, and they can use that money however they want. They can use it to pay for a family member or a friend or somebody to take care of them, or they could use the money to buy a plane ticket for somebody to come in. There's no need to submit invoices to the insurance company to show how they spent, how they paid, or how they used the money. So indemnity is very nice. You can use unskilled caregivers. Elimination period, Lincoln does not have an elimination period, so that's nice. So client, once they have a policy and goes on claim, they can start receiving benefits right away. Minnesota Life nationwide, it's 90 days, and that's fixed. There's no option on that elimination period. Residual death benefit or guaranteed death benefit. So what this means is, for example, with Minnesota Life, if the insured goes through is on claim and goes through their whole death benefit and their long-term care benefits, they're guaranteed that upon their death, their beneficiaries would still receive a $9,600 death benefit. You see nationwide 19,200. Here are the premiums for the three different policies. Fairly similar, but we would recommend the nationwide policy. It has a decent, it has everything we're looking for. The death benefit, the 3% compound, it's an indemnity, and it's less money. I think you'll realize that almost all the times your clients are looking for a decent product that has the least premium. So we would recommend that nationwide policy for Bill. But that's only a policy for Bill. Now we wanted to cover Betty too. So Betty would have to get her own policy. So if Betty applied for the same policy, a policy with the same benefits as Bill, their premiums would be that's a joint premium. So that's for both Bill and Betty. So again, we'd recommend nationwide 16,999 for the two of them to have that hybrid life policy. So there is a company that does offer a joint policy, and this is with State Life under One America. So State Life policy is a second to die whole life policy with a long-term care rider. So it pays a death benefit upon the second death. It provides long term care benefits for both of them. So, whether living, they can both be on claim at the same time. If they're on claim at the same time, they're using up 2 months. And the nice thing about this uh, joint policy is it offers lifetime benefits. So, not many companies, very few companies still offer lifetime benefits. None of the long term care companies we work with offer lifetime benefits. But if your clients, maybe they have some family history of Alzheimer's or dementia or something, and they really want to have an option to know that their care would be covered no matter what, this lifetime option is a good thing for them. And this product has many premium options: single pay, short pay, lifetime premiums. And how does it compare to the other long-term or the other hybrid policies we're looking at? So with state life, they're pretty similar to the other three, but here are the differences. Again, the state life has the unlimited benefit period. So with the other three, they each had 4 years. The death benefit, 133,333. So that's again, there's only that one death benefit. With the other three, I'm sorry, yeah, with the other three companies, they would have each of their own policies, so they would receive two death benefits. And the other difference is there's no residual or guaranteed death benefit on this state life policy. And you can see the premium for the state life is quite a bit more expensive, but again, you're getting unlimited benefit periods. So let's compare that traditional long term care policy to the individual hybrid life policy and the state life policy. So let's assume that Bill and Betty went on claim at age 86. By age 86, they would have paid in 153,840 on that Mutual of Omaha long-term care policy, and that's without taking into account that they could have a rate increase. We don't know if they're going to have a rate increase, so we're just going to say they don't. With that nationwide policy, after paying premiums each for 10 years, they would have put in 169,999, and then One America, $254,040. So if they go on claim at this point, the long-term care with Mutual of Omaha pool is growing to 678,672. The nationwide 974,860, and then again One America's Unlimited. No death benefit on Mutual of Omaha. Nationwide has the largest because of the two death benefits. No return of premium with Mutual of Omaha. Nationwide has the nicest return of premium. And when they go on claim, reimbursement for Mutual of Omaha and One America, and indemnity for Nationwide. So we would recommend, I think the nationwide policy has everything they're looking for. It has a nice high long-term care pool, it has good death benefit, return of premium, and it's indemnity. But that Mutual of Omaha policy may be attractive for your clients because a lot of clients cannot afford those high upfront premiums. So with Mutual of Omaha, their upfront premiums, their premium year one $5,000 versus nationwide about 17,000, and state life 25,405. So Mutual of Omaha policy is still very attractive for your clients that want the lower level premium. But again, the nationwide very attractive if they can afford the upfront premiums, and then One America for those clients that want those unlimited benefit periods. So now let's shift gears here a little bit and talk about another product that's on the market. There's Jeff and Judy, and we're going to say their age is 59 and 55, and they need long-term care. Jeff has a life insurance policy with a cash value of $123,000. So they no longer need that $300,000 death benefit on that policy. Their kids are grown, their mortgage is paid, so they're not the biggest need for that death benefit. But they want long-term care. So what can they do with that 123,000 to cover both of them? Well, the rules say when you do a 1035 exchange, you have to do like to like. So for life insurance. So Jeff is the insured and the owner of his existing life insurance policy. So they're not able to roll it into a joint life insurance policy to cover both of them because Judy would be on it. So it's not like to like. So again, cannot do a 1035 exchange into a joint life insurance policy. But you can do it into a hybrid annuity with a long-term care policy. The rules will allow to take that money from that life insurance policy that's owned by Jeff, and Jeff is insured, and put it in a hybrid annuity, cover Jeff, and add Judy on as the second insured. So what is a hybrid annuity? It is a fixed deferred annuity with a long-term care rider. It provides a monthly long-term care benefit, and for both of them, long-term care pool about 66 months. So again, if they're both on claim, they'd be using 2 months, so they would last 33 months if they both went on claim at the same time. Very minimal underwriting for this hybrid annuity. Um, because the hybrid annuity, the base policy, the first 33 months of care is funded by the premium that they put into the policy. After 33 months, 34 to 66 months, then you're using the insurance company. So clients that sometimes that have not been able to qualify medically for traditional long-term care or hybrid life policy, we can get them a hybrid annuity. But that little hard part is with the hybrid annuity, the only form of premium allowed is a single premium of non-qualified money. But in Jeff and Judy's case, we can use that 1035 exchange and add on the spouse. So if they did that, what benefits would be provided by this annuity? $3,736 monthly long-term care benefit, 66-month benefit period, 90-day elimination period. So taking that 123,000 that they had in that old long life insurance policy, rolling it into this policy to give them the coverage that they need now. So a good option for them. And we can add a 5% compound inflation rider onto the continuation of benefits rider. So the base policy, the first 33 months, we cannot add an inflation rider on, but we can add it on to the second part or the continuation of benefits rider. So the policy will grow. Okay, well, now let's talk about another product, what I call Plan B. This is short-term care policy. This type of policy came on the market several years ago. We just started offering it about 2 or 3 years ago. This is a good option for some clients. So, what is short-term care? It covers facility benefits and hospital indemnity, and you can add a home health care rider onto the policy to cover home health care. Benefit period ranges from 90 days to 360 days. So this is why, thus the name short-term care. The longest benefit period, 360 days. But you can go on claim twice in a lifetime. Elimination period, 0 to 100 days. Issue age is 50 to 89. Limited underwriting. There is some underwriting. They will order medical records, but it's very limited. It's pretty lenient compared to traditional long term care or the hybrid life policies. So, who are good clients for this product? Well, those clients that are older and maybe past the maximum issue age for traditional policies, or older and can't afford the higher premiums on those other policies. And maybe their health isn't as good and they needed this limited underwriting. So let's look at a policy for Sandra. It's a short term care policy for Sandra. We're saying she lives in Clearwater. She's age 55. When we use that, looking at cost of care in Clearwater, using that 200, that 80% rule, we recommend a $250 daily benefit for her. The longest elimination period, 100 days, which is similar to the 90 days that people most of the time go with on long-term care. Go with that longest benefit period. And the hospital indemnity. The hospital indemnity is part of the policy. We can't, it's not a rider, so we have to have that. This means if she goes on into a hospital, she would receive $10 per day on top of her health insurance. I scaled that hospital indemnity down as low as I could. It can be higher, but in this case, we're focusing on the short term care for Sandra, not the hospital indemnity. For home health care, we add on that home care rider with a maximum benefit of 1200 per week and the longest 52 weeks. What is the premium for Sandra? $777. So, decent premium and gives her care for a year. So let's compare this short-term care for a traditional long-term care policy for Sandra. So I ran these quotes to have as close as benefits as I could. So 250 for both nursing home and assisted living with both products. Adding on that home care rider, 1200 weekly with long-term care. That home care benefit is the same as assisted living, so it's $250 per day. Benefit period on the short-term care, 52 weeks, but again, you can use it twice in your lifetime for two separate events. And traditional long-term care, the lowest benefit period available is 2 years, 100-day elimination versus 90 days, so pretty close. No, there is no option to add an inflation rider onto that short-term care policy. On long-term care, we can add an inflation rider, but for this case, I did not add it on because I'm trying to compare the two as close as I can, apples to apples, to see how the premiums compare. So $777 versus 1596. 1596 almost double, but keep in mind the long-term care policy is a 2-year benefit period, and you can use it 2 years consecutively. So fairly similar, but again, that short-term care policy may be a good option for several of your clients. We offer this with Aetna through Aetna, and it's available in about 35 states. So switching gears here again, maximizing your policy. Last year we had an advisor come to us, and this advisor client had a policy. They'd had it for a little while. It had grown to have a daily benefit of $138 now and a 3-year benefit period, so a total pool of $151,110. And this client was getting older and getting close to going on claim. And the client and the advisor were trying to figure out what's the best way to use this policy. And their thought was that the client will probably need 2 years of home care first. So their thought is let's save the policy. So use during the first 2 years that is using home care, the home care is going to cost $125 a day. So they're thinking of paying out of pocket for the home care and saving the long-term care policy. And then thinking that the next 2 years they may be in a facility. So once in years 3 and 4, use that long-term care policy. Expenses in the facility will be $230 per day. So we looked at comparing the different ways to use it to maximize the policy. So if we did it the way they talked about, first 2 years, receiving care in their home, $125 a day, paying out of pocket for that. At the end of the year, they would have paid out of pocket $45,625 because they've chosen not to use their long-term care policy. And then in year 3 and 4, the insured enters the facility, and their benefits or their cost of care is $230 per day. Remember, the policy had a benefit of $138 per day. 138 times 365 days in the year. The long-term care policy would cover 50,370 for that year expenses. So because the expenses for the facility are $230 a day, they have to pay out of pocket each day. So by the end of the year, they would have paid 33,580 out of pocket. In year 4, again, paid 33,580. So after 4 years of receiving care, paying out of pocket for the first 2 years, and then using the policy, they would have spent 158,410 on the care. But we suggested let's look at using the policy right away. So years 1 and 2, use those long-term care benefits in their policy, which would cover their expenses. Um, they would, because expenses are only $125 a day, benefits 138. They'd have zero out-of-pocket expenses. And then year 3, when they go in the facility, start to use the policy. After year 1, they'd have had expenses of 33,580. In year 4, after using the policy, they only have $9,490 in benefits left because they've used it for 3 years. So in year 4, they'd have out-of-pocket expenses of 74,460. So after receiving care for 4 years, they would have out-of-pocket expenses of 108,000. So roughly about 50,000 less than if they do option 1. So bottom line is, if your clients have a policy and they're getting to the point that they need it or could be using it, encourage them to use it. Don't save it for a rainy day. Use the insurance company's money first, and then down the road, if they need care, then they can look at using their own assets. All right, let's talk about COVID-19 and long-term care. How did COVID-19 or how has COVID-19 affected long-term care insurance? Well, in March of 2020, when the world pretty much shut down, Mutual of Omaha started limiting applicants to age 64 and under. And why did they do that? Well, age 64 and over, they require a face-to-face interview. So that means they send a nurse or a caregiver, well, makes a nurse into the applicant's home to do a face-to-face interview, a cognitive interview. Well, when COVID struck, they could not find nurses that were willing to go into the homes, and most and clients did not want anybody into their home, especially these older clients did not want anybody coming to the home. As things settled down a little bit, we kind of adjusted this summer. Those restrictions were lifted, and now Mutual of Omaha has no restrictions on age applicants. Well, they have the regular maximum issue age of 79. And we saw rate increases because of the low interest environment. Several of the long-term care companies and the hybrid companies did increases on their current products. So rate increases for new applicants. And what effect will COVID have on nursing homes? Well, nursing homes have been poorly funded and is insufficiently monitored over the years. And in recent years, nursing homes have seen decreasing occupancy rates because Medicare and Medicaid have to limit spending. The amount of patients were being discharged from hospitals, and the amount of patients that were sent to rehabilitate to nursing homes and rehabilitation facilities has lessened because Medicare is trying to cut down on costs. So these nursing homes have received less patients. And now since COVID, these numbers have really dropped because nursing homes are fearful of an influx of COVID patients. So nursing homes that have been struggling in the past now have to spend more to stop the spread of COVID and may not be able to keep their doors open. Those nursing homes have to spend more to sanitize and keep everybody safe in the nursing homes. So what is going to happen? So now even more than ever, I think home care is more appealing than ever. So people want a plan to be able to afford to stay in their home as long as they can. And let's finish up by talking about LTCi and rate increases. So over the years, the last 20 years or so, there's been many changes in the industry. When these products first came on the market 40 some years ago, the actuaries did not know how to price the long-term care because they had no experience. They didn't know what claims rates were going to be or lapse rates. So the products ended up, they were not priced correctly. So over time, we've seen those big rate increases. But they've been making changes to the product. Their products are priced better now due to the maturity of the industry, and policies have been modified. They no longer have unlimited benefit periods. There's no short pay premiums, no 5, 10 pay, or single pay. It's all a lifetime premiums. About 5 or 6 years ago, the insurance companies, their industry, went from unisex pricing, where the prices for male and females were the same, to gender specific pricing because time has shown that females go on claim more often and they stay on claim a lot longer. So prices are more now for a female than a male. Here's a real quick policy review. I receive a lot of policy reviews. Clients advisors come to us, especially when clients have received a rate increase and they know their premiums are going to go up, and they want to know, should we hold on to this policy or should we get a new policy? Maybe we can do better with a new policy. Well, no. Um, or maybe we should reduce down the benefits, and sometimes that's the answer, to reduce the benefits. So here's a policy review we had fairly recently. Jack and Rose, obviously, changed their names, but this is a real case. 72 and 67. They purchased a policy back in 1999. It originally had a benefit daily of $130. They have 5% compound inflation rider on the policy, so now the daily benefit is $345. They had unlimited benefit period. As we've talked about, on traditional long-term care can no longer get that, and they've had increase of premium. With the new premium is going to be $8,172. So they asked us to see what they could replace this with, what a new policy would cost them today. Well, guess what? New policy today, 34,757. And actually, I say new policy today with same benefits is not really the same benefits because we can't get that unlimited benefit period. So I ran it to have a 6 year benefit period, which is the longest available. So with a 6 year benefit period, premium 34,757. You know what? They held on to their policy. Not surprising, but I gave them some tips on how they might want to reduce down the benefits to keep their premium, to get the premium down lower, to keep it down where it was. Um, Look at going with a shorter benefit period, seeing if the company will allow them to take that inflation rider down a little bit. So always happy to do policy reviews, but I don't think I've ever recommended somebody drop a policy. All right, we're going to finish up now. Any questions from anybody?
Jill, if you can
Okay,
just open up the the chat.
okay, okay. I see a question here. Question about that case study for Bill and Betty. Having taken care of every possible goal and financial planning tool, one of my clients is contemplating purchasing a long-term care policies for the children when they reach the age of 20. They can take they can take over premiums after the estate is distributed. Her rationale is easy underwriting and lower premiums. My concern is the total out-of-pocket cost over the lifetime. Do you think this is a good idea? If so, would it be better to purchase traditional policies or hybrid policies? Well, I will say that not allowed to purchase a policy at that young age of 20. Minimum issue age on most policies is either 35 or 40. So with traditional long-term care and the hybrid. So unfortunately, that is not an option. Cannot buy a long-term care policy for children that are that young or clients that are that young. But if they purchase it, probably maybe when your clients are in their 40s. Um, Usually, we don't see people buy a long-term care policy much before mid 40s or mid 50s. The reason for that a lot of times is clients have other focuses. They're saving for their kids' education. They're saving up for retirement. But in your case, where the client wants to buy it for their children, they may want to look at buying it when the children get old enough to do that. Okay, let me look. Okay, here's a question. Assuming you think it may be a good idea, what benefit amount would you select and what amounts of inflation rider would you suggest? Okay, so I believe this is part two of that added on that question that I just answered. Again, not an option to buy a policy for clients that are that young. Um, as they get older and get into that issue age, I would look at cost of care in their area. Maybe cover a very minimal amount of cost of care because if they're buying it that young and we add an inflation rider on, that benefit will grow pretty nicely. Okay, here's a question about the hybrid life. Does hybrid life long term care policy have medical underwriting? Yes, it does. So they're underwriting for two features. They're underwriting because it has a death benefit, and they're underwriting because the long term care benefit. So they are going to medically underwrite it. Again, very similar to both products. But with most of the hybrids, there is no exam required as long as the insured or the applicant has seen their primary care doctor in the last 24 months and had blood work. The underwriters will order medical records and look for that. So yes, there definitely is medical underwriting, but no exam with most of them. Okay. This question is during the comparing at age 86. Can you further explain return of premium? Yes. So return of premium in those products, it varies per product, but they all have some form of return of premium. So if you cash it in year one, two, three, four, five, you have some return of premium, but it's very low. But on that Minnesota Life policy where I said it's 100% at age after 10 years. So when you cash it in after 10 years, you get 100% of your money back. If you cash it in earlier than that, you do get some money back, but just not 100%. Every year you have the policy, the longer you have it, the more return of premium is. So in year 20, if they change their mind and decide I'm never going to need this policy, I don't need it, they can cash it in and get 100% of their money back. With with MoneyGuard, it's 70%, so same idea. And same thing nationwide. It just depends on how many years they've had their product, policy, and when they decide to cash it in and get their money back. Question here for traditional long-term care: do premiums continue when a person is on claim? No, premiums are waived when you are on claim and receiving benefit. So even though I said they're lifetime premiums, once you go on claim, the premiums are waived. If you go on claim and use up all the policy, then there's no more premiums. Question here: do you anticipate any big rate increases, or has the industry matured enough that we should not expect large adjustments anymore? So I do think we are going to see more rate increases in the future. I don't think they will be as large. So we're going to see rate increases, especially on those older products that are still out there, that still people have not gone a claim, had the policy, and were priced incorrectly to begin with. So going forward on new policies that have been issued in the last several years or issued today, I don't think on those we'll have as many large rate increases. I think we're still going to have rate increases, but not as large or as often because done a better job in pricing them. Question on the policy review slide: was the $345 benefit for both or each? I believe that was for both of them. It was a joint policy, so they each would have $345 benefit for each of them. Okay, question on the shared care benefit. Can that be added to an existing policy where two have individual policies, or does it require a new quote and on an entirely new policy? You cannot add a rider onto an existing policy. Just think of it that way. You cannot add the shared care rider onto an existing policy, and you cannot add any rider onto an existing policy. Usually, when you add a rider on, you're increasing the coverage, so you're increasing the risk for the insurance company. So the insurance company, when they're increasing the risk, they want another look at the insured. They want the insured to go through underwriting so they can look at them. So if clients have an existing long-term care policy, the only way we could get them a shared care policy is to get them a second policy with a shared care. So they may want to keep their existing long-term care policy and add a second policy on because you can have more than one policy for long-term care. You cannot file a claim and receive benefits twice for the same care. But if you have, let's say you have two policies, one pays $100 a day and one pays $200 a day, and you have a claim for $300 for that day, you would file with the first company, and let's say the first company benefits $100, company would pay you $100, and then you can go to that second company for the other $200. So yeah, you can't get $300 from two companies, but you can divvy it up. Do hybrid policy premiums have the same tax deductibility as traditional long-term care premiums? That's a good question. I know that I do not believe that they do. I do not believe you can use them like the hybrid policies. I don't believe for the business owners they have the same tax breaks as traditional long-term care does. I'm not sure who asked this question, but if you'd like to call me at the office, we can look into that a little bit further. I know the hybrid policies do not qualify for partnership program that traditional long-term care policies do, and I don't believe they have the tax benefits, but I would have to check on that 100%. If each spouse has a whole life policy with cash value, can you combine those into a shared policy? No, you cannot. You would have to take the money from one policy. And again, we're talking, remember what I said for life insurance, you cannot, you definitely cannot take the money and cover two people. You can't do that either way. You can't cover two people and do a 1035 exchange on a life insurance policy. If your clients have a life insurance policy where it's a joint policy where they're both the insured and both the owner, you could roll it in, do a 1035 exchange into a joint policy. You can, and I believe even if they have joint or if they have individual life insurance policies, not an option to roll it into that hybrid annuity and use both policies. You can take the money from one spouse's policy and put it in that hybrid annuity and cover both of them, but you can't take the money from both policies and put it into that hybrid annuity. Okay, question here. Any issues with children buying long-term care for their parents when they are concerned parents may need but can't afford? No issues with that. I've heard of several times that we've worked with clients, the children are concerned about their parents. They know their parents should have some long-term care, and the parents can't afford the premiums, so the children pay the premium for the parents. The insurance companies are not concerned where the money's coming from for those premiums. If the children are paying or the adults are paying it, that's fine. So that's perfectly able to do that. Uh, Here's a question. If you own two long-term care policies, which one pays first? My understanding is you would file a claim with the oldest policy first. Most companies that I've talked to, that's the way they handle it. So if you have a policy A purchased 10 years ago, policy B purchased 5 years ago, file a claim with policy A first. And whatever that policy doesn't cover for the daily or monthly benefit, then you would go to policy B to get them to cover the remainder. And I think that's it. That wraps up all the questions. Thank you, everybody, for attending today. Hopefully, you found this beneficial. And if you have any other questions, you can please send me an email or give me a call, and I'd be happy to go over it with you. All right. Thanks again. Take care, everybody. Bye bye.